There's one ETF that income investors keep coming back to, JEPI. With over $35 billion in assets, it's become the go-to choice for people who want serious monthly income without abandoning the stock market. But is it actually as good as the hype? Let's break it down. JEPI is the JPMorgan Equity Premium Income ETF, managed by JPMorgan Asset Management. It launched in 2020 and has grown into one of the largest actively managed ETFs in the world. The goal is straightforward: generate high monthly income while providing some exposure to large-cap U.S. stocks. It does this through a two-part strategy, and understanding both parts is key to knowing whether JEPI belongs in your portfolio. Here's how JEPI works. First, the fund holds a defensive equity portfolio of about 100 to 135 large-cap U.S. stocks, selected by JP Morgan's research team for their stability and lower volatility. Think of it as a slightly more defensive version of the S&P 500, similar companies but weighted towards steadier names. Second, on top of that stock portfolio, JP sells equity-linked notes, or ELNs, which are essentially a packaged form of covered call options on the S&P 500. Selling those calls generates premium income, which is paid out to shareholders as monthly distributions. The trade-off: when the market rallies hard, JEPI's upside is capped because the call options limit how much appreciation it can capture. But in flat or declining markets, that premium income acts as a cushion. Expense ratio: 0.35%. Current yield: approximately 7 to 10% annually. It varies with market volatility, since higher volatility means higher options premiums. Monthly distributions. Holdings: roughly 100 to 130 stocks. Actively managed by JP Morgan. AUM: over $35 billion. Launched in May 2020. JEPI is built for investors who want meaningful monthly income and are willing to give up some upside in strong bull markets. If you're retired or near retirement and want your portfolio generating real cash flow every month, JEPI is designed exactly for that. It's also a good fit for investors who find pure bond funds too boring but want something less volatile than a straight equity fund. It's not the right choice if you're primarily focused on long-term growth. In strong bull markets, like 2023 or 24, JEPI significantly underperforms the S&P 500 because the covered calls cap its gains. You're trading growth potential for income stability. That's the deal. JEPI earns its spot as one of the most popular ETFs in the world for a reason. The combination of a quality equity portfolio and disciplined options writing gives you income that most bonds can't match, paid monthly, with less volatility than a pure stock fund. If income is your priority, JEPI is one of the best tools available. Just go in understanding the cap on upside. That's the price of the yield. Subscribe for more no-fluff ETF breakdowns. See you in the next one.